Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Yoni Schmidt here, hosting today's episode of the Same Day Podcast. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping clients buy, renovate, operate real estate assets. We help our clients build wealth while taking the headache out of property management. That is why no matter what asset you have, what rental you have, single-family homes, condos, townhouses, apartments, we have the management solutions for you. Go to KeyrenterPMC.com or email us at info@KeyrenterPMC.com for more information. Today's guest is Bob Bernotas. Bernotas, sorry.
Close enough. It's all good.
President of FranchiseWithBob.com and a highly experienced franchise consultant, investor, and entrepreneur. Bob has been working in the franchise industry since 1986. That's before I was even alive. As a multi-unit owner, franchise CEO, and trusted advisor to investors and executives seeking to build wealth through semi-passive business ownership. Bob specializes in helping busy professionals and real estate investors identify franchise opportunities that align with their capital, risk tolerance, and lifestyle goals. If you ever wondered whether franchises could provide cash flow and equity growth comparable to real estate, this conversation is for you. Welcome to the show, and thank you for being here.
Hey, thanks for having me on. Great to be here.
Bob,
by the way, I mean, since 1986, and I know you weren't born then, but that makes me sound really old, man. In my defense,
experienced.
Well, I have the same Aura ring. In my defense, I was a kid in my 20s when I got into my first franchise. So there you go.
Nice. Well, actually, let's dive right in. What was that first franchise? You've been involved in this since 1986. Like, what was that first franchise?
Yeah, well, I mean,
into the industry too.
A lot of your listeners may not even remember this industry, but if you remember the video rental industry, renting VHS tape. Okay,
Blockbuster.
Yeah, well, this was even I was in one called West Coast Video. They later bought National Video. They had over 1,000 units across the country combined with National Video, but it preceded Blockbuster. But I bought my first unit back in 1986. I opened it in December of 1986 in a little area of Philadelphia called Germantown, and it just fortunately that unit took off for me really quick and. Opened it in December. That January, a month later, it became the top unit in the chain, which that gave me the springboard to move into multiple units in that market and then move up into New York with them as well. But everybody knows where that industry is now. It's gone. Taught me a valuable lesson.
Yeah.
But
Did you
was
hold
good
on until the end?
No. I got out of I saw the writing on the wall and I got out and I made decent money with it. But if I got out early, I would have made a lot more money. But a lot of my colleagues stayed in long term and went right down the tubes. But I mean, I thought the writing on the wall was pretty obvious that technology was going to wipe this out. But
yeah, people
hung on, man. They didn't want to quit.
Yeah. I mean, I remember as a kid going to Blockbuster. I grew up in the Middle East and we had a Blockbuster, in downtown Jerusalem, Israel, which is where
Yeah.
thing. I mean, going with my parents to pick out movies and take them home.
That is awesome.
I love that. Yeah. So that's awesome. But yeah, Netflix and technology really kind of wiped that industry out. Let's talk a little bit about.
I think there's only one Blockbuster left somewhere in Oregon for nostalgia purposes, but the rest of the industry is gone.
They might be turning it into a museum pretty soon here.
Yeah, there you go.
Let's talk about someone who's new to the concept of franchises, right? Sure. What exactly is semi-passive franchise ownership? Why is it appealing to, someone who's a busy professional, like many of the people who are listening to our podcast?
Semi-passive franchising is just it's a concept whereby the franchisor has developed a robust enough support platform so somebody doesn't have to step into it on a full-time basis. Now, understand there's all kinds of definitions of semi-passive. Semi-passive could mean 20, 25 hours a week, which I don't really consider semi-passive. It could be It could be like what I'm doing right now. I mean, I bought the most recent franchise I bought is something called Game Day Men's Health. I bought 6 units of that concept. They're 2 hours from me because everything in my immediate market sold out so quickly. I got involved in some site selection, but ever since then, my involvement has been a 1 hour Zoom call per week. Now, that's extreme situation, but I would anticipate semi-passive. Most people are going to get into it and maybe put somewhere in between 10 to 15 hours a week in the early stages. Once the systems are running smoothly, have the right people in place, now you can start backing off and spend less and less time.
Yeah. And so basically you're putting in an operator, someone who's managing the business. They may have some equity in the business because you want them to have, skin in the game and long-term, buy-in, right?
Yeah,
And
yeah.
you're basically, capital consulting, advice, maybe opening doors, making introductions, helping grow the business on the front end, until
Yeah.
it's kind of like in a flywheel kind of place.
Correct. And to your point with Game Day Men's Health, I mean, the way this came about for me is because I at this point in my life, I'm not putting a lot of time in anything other than
Mhm.
my consulting businesses, the franchises I own. I don't want to put a lot of time into. But I was actually working with a local client. I showed him this concept. He absolutely fell in love with it. He just didn't have the capital to execute. It was going to be a stretch for him to do one. So I said, John, hey, would you want an investor? Would you want a partner? And he
Mhm.
said, sure. So we started, instead of talking about one, we started talking about three. And then all of a sudden it turned into six and bought 6 units. The first two are open, doing great. I mean, the first unit opened 17 and a half months ago. I think it's been at this point. Last month, we did 124K in revenue. I mean, it's been building. It's a membership based reoccurring revenue model. So it builds each month. 124K last month, over 30 plus percent profit margin with this.
Mhm.
And so, I mean, I could probably sell that unit right now for a couple mil.
Yeah.
Based on where it is in its trajectory, and I'm only open 3 days a week because I'll go to a fourth day, I'll go to a fifth day eventually as membership bills as it's continuing to do.
Yeah.
Uh, my investment was 350 on that first unit. So that's an example of a unicorn. There's not a lot of concepts that I can show, clients that are going to perform like that. But if, I'm working with a client and they give me the latitude to say, hey, Bob, show me ROI earnings. I don't care what the widget is as long as it's ethical, provides valued service to the community, and show me something semi-passive. If they give me that much latitude, I can show them some really good concepts.
Yeah. Love that. Let's talk a little bit about, franchises versus real estate investing. Maybe, real estate investors have a ton of equity that's tied up in, their properties and their real assets, and they may want to diversify a little bit and
Yeah.
go in a different direction, to maybe generate more cash flow and then maybe go buy more real estate, grow their franchise business, a lot of different things. Many of our listeners, as you may or may not know, are real estate investors. How do franchises compare to, rental properties in terms of maybe cash flow, leverage, long-term equity creation, and so on?
Yeah, a great question. By the way, I love real estate. I mean, I'm in a number of syndications, so I'm also a real estate investor, and I think that should be part of anybody's portfolio. I think where they're going to diverge is with franchises. Is the risk factor higher? Yeah, but it's not that much higher if you get into the right franchise, if you know what to look for. But you're going to build equity at many multiples of real estate. Now, look, if you got into real estate right before COVID, it was a nice time to get into real estate. That's not realistic on an ongoing basis. But like I said, with Game Day, the one that Game Day Men's Health, the one that I bought my first unit at this point, and realistically, I mean, 40K to the bottom line at this point, close to it, and multiply that by 12, say a 5 multiple, it's over 2 mil. I mean,
Mhm.
there's not too many things you can open 17 and a half months ago for 350 and have it worth a couple $1 million at this point. I mean, that just doesn't exist. And again, that's a unicorn even for franchising. That
Mhm.
rarely exists, but if you know what to look for and you're willing to wait for it, these types of concepts emerge.
Yeah. I mean, because, I've always been under the impression that, the statement, if you build it, they will come, is not one that's true, right? You really have to know who your clients are before you go to market and before you have a product. I even, read an article about an entrepreneur who was saying you should market your product before you even have it, to see what kind of interest in activity you can generate before you even have the product.
Yeah.
So let's talk, I guess, about choosing the right franchise, right? What are the biggest mistakes people make when they're evaluating franchise opportunities?
Yeah, well, but if I can just jump back for a second, what you just said, I think, is really important, and offering or selling the product before you even have it. That's part of a lot of models, by the way. I mean, for instance, I couldn't do it with Game Day Men's Health because people have to be tested before they become a member. But there's a lot of franchises out there where memberships, before a franchisee is ever open, companies help them with pre-sale of memberships. So they may open, even theoretically, and in some cases realistically, at a profitable level the day they open their doors because of the pre-sold membership. So that dramatically reduces risk in those situations. So I like reoccurring revenue models. I think they make a lot of sense. They typically are going to sell at a higher multiple if you decide to make a move at some point in the future. But I also want to make sure with any of the clients that I work with, we always talk about, exit strategy, I think, is one of the key things you can possibly consider when you're getting into a business for a variety of reasons. But whether you want to, have a short horizon, like I look at things at a 3 to 5 year horizon, I want to be out, be it 5 years, 10 years, 20 years, and have a transaction and sell it for many multiples. But often, life events occur and you may need to sell your business. And strategies around selling it sooner rather than later if you need to go about doing that. Being able to reliably predict that whatever brand you get into is going to predominantly or entirely sell out in the market you're in, which means it will predominantly sell out around the United States. That's important because that puts you in a much better position to sell your franchise. And there's kind of an art to that. I knew when I bought Game Day Men's Health, based on where they were, the numbers behind them, I tracked them for a couple of years before I ever made my purchase with them. But as soon as they got into the right organization that's behind them, that would help them grow, and I know the organization and one of the top organizations in terms of what they do, I knew that brand was going to blow up across the country, and I timed it right, and it fortunately worked out well for me. Now, what was your question, Yanni? I'm sorry, I went on.
Yeah, what are the biggest mistakes? I know, I appreciate that, but what are the biggest mistakes people make when they're evaluating these franchise opportunities?
Yeah, people want to go for big brands. People see, a brand that they recognize, and it's and that's natural for anyone to. But I can tell you, the opportunity's over, and it's not even if the brand has available market to buy. You probably don't want to buy the markets that they're offering at that point.
Right.
A universal, immutable law in franchising is that the first third of franchisees that get into any franchise system will almost always do better than the final third that get into the franchise system, simply because what are you going to choose first? You're going to choose the tier 1 territories. You're going to choose the best territories. They get bought up first. Once they're sold, then the tier 2 territories start to get bought up. And eventually the tier 3 territories start to get bought up. And the problem is a lot of these franchise companies, they may reject those tier 3 territories up front. If somebody lives in that area and they want to be in their own market, like, oh, sorry, it's not strong enough. But once everything else is sold, guess what? They go back and they sell those territories, and often they shouldn't have sold those territories. So my counsel to anyone would be, hey, don't focus on the big brands. Focus on things that we can reliably predict are going to grow, the emerging brands, but they still have to have all the elements behind them. They have to have a strong management team. They have to have the capital behind them. They have to have strong unit economics. They have to have the infrastructure to scale. If they can check all those boxes, and even more importantly, if they have the right organization behind them, because franchising has evolved from these mom and pop type concepts that launched 20, 30, 40 years ago and maybe had success. Rarely do you see those succeed now. Now there's bigger organizations behind them with a lot of capital. And if it's not the right organization, I avoid those types of brands.
Yeah, that's interesting. It also answers the next question of why boring service-based franchises often outperform more glamorous businesses like those brands that you mentioned. But I guess a follow-up question would be, you mentioned the first third, right, are often, the ones that will outperform the last third.
Right.
And, are the first third also sold at somewhat of a discount because they're testing the market? Is it like a stock that IPOs that you can come in on the ground floor and say, okay, I'm buying it for a little bit of a discount because you're a new franchise, you're a new concept, you're coming in and you're testing the waters here, would those be cheaper than if you are in a proven model?
Absolutely not.
Okay.
Look, if companies are doing that, if they're discounting at the beginning, now they may just universally have a lower franchise fee, and that's a natural evolution. Later they bump it a bit, later they bump it again. The royalty fees may get bumped. Doesn't affect the franchisees who are already in. Those fees are locked in. But it could affect, newer ones coming in the future. But usually you're not seeing a giant. But if they start negotiating and like, oh, we'll sell you the franchise fee for half price, you probably don't want to get involved with that company. That's a show of desperation. Look, if there's a commonality, if I'm working with a client, there's always a commonality they will see. There will either be a really strong brand aggregator behind the brand that I will show them. Brand aggregator is an entity that acquires brands. Okay, they put them on their platform. They supply the franchise expertise. They supply the capital. They supply the infrastructure to scale, and then they start growing that fledgling franchise company on their platform. Another entity is something called an FSO, or franchise sales organization. And look, there's dozens of them out there. There's only 4, in my opinion, that are good. Okay, so I only will deal with those companies. Same thing with brand aggregators. There's only a handful that I will deal with. The rest of them I want nothing to do with. If a brand gets into the portfolio of one of those organizations, one of the better ones, I know there's a really good chance that brand's going to be very successful. So the commonality that anybody that I work with will see, there will be one of those entities or possibly both behind any brand that I show. It's just a much safer investment. They know what they're doing.
Mm-hmm. You mentioned earlier unit economics, right? What are those key unit economics and metrics that every investor should understand before they sign on the dotted line of whatever FDD or buying a franchise? In your opinion?
Yeah, well, when it comes to unit economics, I mean, it's what somebody's looking for and what they're comfortable with, what the return on investment is, and often people will say, "Well, it doesn't matter. I can make less money with it as long as the risk is less. I'll get in." It doesn't necessarily work that way because some of the best things also have the greatest rate of return. So typically, they could have great unit economics with a few locations. Like when I started evaluating Game Day Men's Health, and this was years ago. I mean, it was a while before I bought. They just franchised, but they didn't have any franchises behind them. They got a few sold and whatnot, and so I loved the unit economics behind them. When I looked at they had 6 corporate owned units in Southern California, so all in one market. But the 6 units were ranging anywhere from a year old to 5 years old. They ranged, like the year-old store did $1 million the previous year. The 5-year-old store did 2.5, I want to say it was. But the year-old store made really good money. The store that was 5 years old dropped like 9 something to the bottom line. So those are very, very impressive unit economics and an investment that's relatively low. So I was very interested in that, but I didn't know if they could scale. I didn't know if they can truly build this across the country and keep the wheels on doing it. They had the capital behind them. They had a good management team behind them. But once they got into the portfolio of a really good FSO that I know and trust, I knew it was going to blow up across the country, given the category it was in, longevity. Just
Hmm.
a very, very hot category. And the cost of this franchise, unfortunately, I was right. And within 17 months, they sold 900 and some units, completely sold
Wow.
out the United States and Canada. One of the fastest growing brands I've ever seen.
Wow. And the longevity, this is cryogenic stuff and or not so much.
With this, no, they don't use cryogenics. With this one, this is just men. It's hormone replacement therapy, weight loss, peptides, ED treatment. Now,
Yeah.
there's some other ones that have emerged. One in particular I like a lot that is not only doing that with men, but offering it to women as well. And they have other parts of the business, like an apothecary selling a series of products, but they also have some of the things you were mentioning, like hyperbaric chamber, cold plunge
Hmm.
therapy, red light sauna, IV drip therapy, compression therapy, things of that nature. They're putting it all together under one roof, like a really serious longevity concept for both men and women and appealing to a lot of age groups. So I do like that concept. More expensive to get into, but I think it's a great concept.
Interesting. I want to talk a little bit about, Keyrenter. We're a franchise business model. There are a bunch of different key renters all over the nation. We operate seven of the markets that Keyrenter is in, currently managing roughly 3,600, mostly single family residential homes.
Right.
One of our markets, in the Midwest, there was a competitor franchise. I'm not going to name it, but there was a competitor franchise, and the franchise owner had, grown and scaled their business, and they wanted to sell, right? And it seemed pretty, I guess obvious that it's a property management business. They could sell it to anyone who wants to operate a property management business.
Right.
But when Keyrenter stepped in, we were having a conversation. We had, great rapport with this business owner. This business owner was concerned about selling to us because we weren't within their franchise brand. We were in a separate
Mhm.
franchise brand,
Right.
and it created, it killed the deal ultimately.
Yeah, I
Um,
would imagine. Yeah.
what's your advice on something like that for someone who, is getting into a franchise model that that you may be able to sell to anyone else? Like, is it common for someone to have to buy into that franchise and pay another franchise fee, essentially, if they're coming in and they're buying that business? And what should people who want to get into franchises look for in the contract to avoid that if possible? I don't know if it is.
Yeah, I mean, look, any franchise organization typically isn't going to allow you to compete against them. So if it's an organization, if you want to sell to this other or buy this other franchise, you own one franchise, you want to buy another one and be absorbed by it. Is that your question?
Well, yes, but it's the same industry, but two separate
Right.
brands.
Well, the brand that would be absorbing you would be happy. The brand that is
Being
you're
absorbed.
being absorbed by not going to be happy at all. And
Yeah,
in their franchise agreement, it's going to prevent you from being able to do that. So,
yeah. So her options were, I can sell it to another franchise owner that's the same brand
right.
within their market who said, why would I buy you? If you stop working, I'm going to swallow you anyways. That's what he said to her, right?
Yep.
And or her other option was to essentially, I mean, really like take the risk, which she didn't want to do because then they could sue her,
Yeah, and they will.
and they will.
Unless,
Or
unless the
or there was a third option. Sorry, find someone who wants to operate in this industry, and they would be willing to buy that franchise from her.
Yep.
But that person would have had to make, about a 50, 60, $70,000 investment to essentially like buy the franchise from the franchise and then also pay her for her recurring revenue,
Yeah, I
whatever
mean,
her business is worth.
if her revenue was worthwhile, or if it had a bottom line and it was worthwhile, and somebody just has to pay, the franchisor pay them out, then it would be. It seems to me it would be worthwhile. But a lot of franchisors will typically, I mean, if she wanted out, I mean, she could just, I mean, walk away and hand the keys over, but that isn't what she wants to do. She wants to sell the business, but it might sell at somewhat of a premium. Well, first of all, wait a minute. The franchisor, the only thing that they should be looking is whatever the transfer fee is. She can sell to anybody she wants to. They
Hmm.
can't stop her from selling her business unless the person isn't qualified that she's selling it to,
Hmm.
based on whatever the then current minimum standards are for someone to buy into their franchise. But
Hmm.
otherwise, she should absolutely be allowed to sell her franchise to whomever she wants. Now, there might be a transfer fee, $10,000, 25% of the then current franchise fee, something like that, that because they have to retrain the franchisee their way or
Hmm.
whoever's coming in their way. But they typically, brands have no issue with you selling it.
Yeah. As long as you maintain the brand, you can't sell it to another competing.
Right. Correct. Yeah, that's a problem. Yeah, you
That's a
can't do that.
problem. Yeah.
Yeah.
Okay. Thank you for answering that. Some of my next questions are about timing and execution, right? Can someone buy a franchise while they keep their day job? And, if they do, what does that typically look like?
Yeah, I mean, most of my clients, that's what they're looking for. They're looking for a semi-passive brand, and it could be. I mean, depends on how much time they have and what those hours look like during the week. Some brands are more semi-passive than others, and it depends upon. I mean, for instance, if you get into a model that is you mentioned, one of the dirty businesses or a home service type business. Most of them cross over to B2B as well. You're probably going to spend more time in that in the early stages. So I would say even if they had a semi-passive platform, you might be looking at somewhere between 10 to 20 hours of your time per week. Eventually,
Hmm.
there will come a time where you can take a big step back and then another big step back once you have the right people in place and systems are running smoothly. But then
Hmm.
on the other side of the ledger, there are manager to manager type models where you get into something. Typically, they're brick and mortar,
Hmm.
and it could be something. I mean, you pick a category. Let's say it's service, retail service. Like a Pilates franchise, which by the way they do super well, but they're typically managed to manager models, and they're one of the models whereby the franchisor will help you pre-sell memberships. They'll help you find labor. Once you have your labor in place, you have your manager in place. You don't have a role in daily operations. You're managing the manager, the key performance indicators, and the profit and loss. So once
Hmm.
it's up and running, give it a couple, 3, 4 months in, you're just keeping tabs on it. You're stopping in once in a while to see how everything's going. So it ranges from that all the way up to maybe 20 hours of your time per week.
Interesting. You mentioned, the semi-passive. Like, what are those operational systems that need to be in place to truly make a franchise semi-passive?
Yeah, I mean, these companies will have all of the bookkeeping in place, so you just plug right into it. Many of them are going to have a national call center. So instead of you hiring admin people that are going to man the phones, and you have to train them so they can effectively sell your product. Because if it's a home service type concept, it might be, hey, the only thing they're selling is scheduling an appointment for the salesperson to go out and meet with the homeowner or meet with it could be B2B, meet with the business, whatever it happens to be. Or it could be such a simple service that, like a franchise that, believe it or not, there's a grill cleaning franchise out there that's doing really well.
Yeah.
They just schedule, the tech people call, they're told, how it works. The call center will schedule the technician. Technician goes out, does the service, might be a $300 to $400 for like a 3 hour service is done typically on, higher end grills. You're not, but those things aren't going to require. So that's like a support platform for something like that.
Interesting. And it's strictly grill cleaning.
That's all they do. Grill cleaning, part replacement, grill replacement. Hey, we'll get rid of we'll dispose of your old grill. We'll install the new grill for you. But grills, these parts start wearing out and they replace parts and things like that. But the bulk of the business is actually cleaning, and it can apply to commercial as well, like
Hmm.
HOAs and whatnot, which could be,
Restaurants.
really reoccurring. Yeah, correct. Golf courses, restaurants. Yep.
Interesting. Um, that I'd like to learn more about that.
Yeah.
Let's talk a
Cheap.
little bit
Cheap
about
too.
um, funding, structuring the investment, right? Someone who says, I want to do this, how do I do it? What are the most common ways that people finance franchise acquisitions? I guess a small business loan.
Yeah, I mean SBA is a pretty common way. SBA is a pain in the butt, but it's also pretty good terms. You're getting 10-year terms, reasonable interest rate. You can pay it off sooner if you want to. You're not going to get penalized there. So a lot of my clients will use SBA. There's portfolio loans against a stock portfolio. There are obviously home equity loans, things of that nature. There's something called a 401k rollover or the ROBS program, whereby you can roll funds out of a 401k or IRA into a business without taxation, penalty, or interest. Now, you have to be eligible for it. So you either have to be a certain age if it is a 401k with your current employer and all your money's in that. But if you control that 401k, if it was from previous employers, or it's an IRA, then there's no problem. You can roll it. You could roll it into a business. Now,
Nice.
under that structure, a little more, it's a layer of complexity because it needs to roll into a C corporation. But the entities that I work with, there's several of them that set these up for people, and then they will manage it and do the filings and everything for you, so you don't run into a compliance issue with it.
And there's no double taxation problem if you're rolling it into a C corp, or
There's no what?
double taxation.
No. They have their methodology for avoiding that.
Okay, wonderful. Let's talk about realistic capital ranges that someone should expect when they are making an investment to acquire, a quality franchise opportunity. What does that look like?
Sure. I mean, like that grill cleaning concept that I mentioned to you, you're going to be in 100, 125 range to launch something like that. Your investment, what they want you to do is pay the franchise fee upfront. Franchise fee on something like that typically is about 50K range, 49.5, I think specifically on that one. And given the cost of it, everything else can be financed. So that's would be something on the low end. When you see franchises out there that are, 30, 40, $50,000 all in, you want to stay away from those. They're not worthwhile opportunities. I would tell you that probably 70 to 75% of the franchises that exist in this industry, I wouldn't go anywhere near.
Interesting.
Don't consider them worthwhile opportunities.
What's I guess, is it better to start a new franchise or try to buy an existing one that's already operating?
Question. Yeah, good question. And look, buying an existing one could be a really solid option. I find in most cases it's not. Here's what? Trying to find a concept that you like in the market you like and pay the price you like, that's the challenge. Okay. So that's a needle in a haystack scenario. So I find it to be a lot easier. And look, if you want to buy cash flow and you're willing to pay someone maybe 4 or 5 times what they paid to launch it 2 years earlier, those opportunities are out there. But do you really want to do that? I mean, if it's a good franchise organization, they should be able to get you to that level pretty quickly. And you've spent a fraction of what it would cost. I mean, if it was an independent business, that's a different story. Okay, you don't have that infrastructure that's going to support you, get you launched, work with you, provide the coaching and everything. And but then you have another problem if it's an independent business that you're considering buying. What I have found, because I've bought independent businesses, what I have found that 90%, 95% of the time they're lying about the numbers. And I can tell you horror stories about that. The numbers have been manipulated and sometimes majorly manipulated. So that's the pitfall there. I always find that, doing a startup, starting from scratch, because typically you're going to pay a fraction of what you would if you're buying unless it's a distressed situation. You buy a recent resale in a distressed situation, if it's brick and mortar retail, that concerns me a bit, because was the problem location? Is that why it's distressed? Because the old adage, location, location, location. If it's something that is, let's say, a service-oriented business, home service, and you're operating from an office or maybe a small warehouse, maybe some flex space, and it's not performing, but the demographics are good, and you can compare these demographics to other markets where franchisees are doing well and they're similar demographics, then it could be a really good situation. And maybe the problem was You had, there was illness, there was death, there was divorce. Something's going on to allow you to grab that opportunity at a really reasonable price. Then I would say it's worthwhile. But finding those situations is a needle in a haystack.
Yeah, interesting. Let's talk about, exit opportunities. You mentioned that earlier, right? Like, what are the exit opportunities for franchise owners, and how do they compare to, selling a real estate portfolio, for example? And keeping in mind that, we had gone through a not really full underwriting, but we had, started a conversation with this other franchise owner who had a difficult time exiting her business.
Yeah. And that is very, very common. And so it's not going to be comparable to real estate in most situations. I mean, look, somebody selling a single family home, that's not going to be typically, if you put the right price on, it's not going to be hard to sell. You get into some commercial situations, it could be hard to sell. But with franchises, you need to position that up front before you ever buy to be able to position to sell effectively. And I mean, it sounds counterintuitive, but here's why. When I'm working with a client, one of the key things that I look for is I'm focused on exit strategy before they ever start. And the way I do that is I want to be able to reliably predict that anything that I put that candidate, that client into, that we can predict it's going to sell out predominantly or entirely in their market. And again, if the right things line up and I can see, hey, this brand has really good unit economics, good management team. They have capital behind them. They have the infrastructure to scale. Now they just got into the portfolio of a really good FSO. I know that brand's going to blow up around the country. So if it sells out in their market, yet we were able to help them get tier one territory, because that's critical. Okay. You don't want to be buying at the end of the cycle and buying the territories that are left over. So if they can get tier one territory within a year, 2 years, it's sold out in their market. Now with the proliferation of that brand in that given market, there is a heightened awareness of the brand. People are seeing the logo on storefronts. They're seeing it on vans. They're hearing it maybe on the radio. They're seeing social media ads for the brand. With that heightened awareness comes a ton of inquiries to the company saying, hey, this looks interesting. How do I get one of these? And then they're quickly told, sorry, everything's sold out in your market. However, we have a resale opportunity. Yanni's interested in selling his franchise. We'll be happy to introduce you. They make the introduction. Person has no choice. If they want to get in the brand, they either can buy a tier 3 territory, which they don't want to go into, or they can buy an existing franchise. And in that case, it's not hard to sell.
Yeah.
If I may give you an example, Game Day Men's Health. When I got into it, I had to move so quickly because everything started to sell so quick. I couldn't even buy territory. I'm in southeastern Pennsylvania. I had to go 2 hours into New Jersey to buy territory.
Wow.
To buy tier 1 territory. I could have bought tier 3 territory that was still left, areas I never want to go to.
Yeah.
So I went to New Jersey and I bought territories in those areas. And then everything just sold so quickly all around there. There was another franchisee that bought, it was a small group. They bought 19 units just to the east of me. Okay. I could have sold my franchises unopened, just territory, dirt at that point, to them for twice what I paid for them. Okay.
Wow.
Just because they wanted I got prime territory. They got good territory too, but they wanted more, number one. And I said, that's some really good territories. So consequently, I could have sold to them and doubled my money. Didn't make sense because I know what the upside of that franchise was. So if you get in the right situation, we can identify the right situation. I mean, it's almost like, there's a frenzy for franchises at times to get that tier 1 territory.
Interesting. Well, for someone who's listening today who wants to create additional cash flow and greater control over their financial future, what's the first step to exploring franchise opportunities?
Yeah. So if I'm working with a candidate, my first step of my process is my confidential questionnaire. It takes maybe 20, 25 minutes to complete it, gives me the initial information I need on the candidate. Then we follow that up with a Zoom call. We spend an hour or so on a Zoom call reviewing the confidential questionnaire, I'm just in information collection mode. Once I have
Mhm.
all the information I need, then I use that information to start identifying brands that are going to fit my candidate, will fit their budget, will fit the characteristics that they're interested in the business, the characteristics of the role they want to play in the business, semi-passive, full-time, how semi-passive, all those things will check those boxes. And then on subsequent calls, I start putting brands in front of them that will check all the boxes. We discuss those brands, and hopefully there's 2, maybe 3 on the list that they say, Bob, I'm interested in diving into these brands, learning more about them. And then I help them investigate the brands.
Nice. Love that. And how can listeners connect with you, and what type of investor or executives tend to benefit from your guidance?
Yeah, I mean, it's all over the board in terms of the types. I mean, it could be anybody from, management position that wants to get into something semi-passive. Maybe they like their job, maybe they don't like their job, but maybe they want to, structure a 2, 3, 5-year exit from corporate America, an off-ramp from corporate America, if you will, or somebody that wants to do it quicker, or somebody wants to do it immediately, or somebody who already owns other businesses. They want to extend their portfolio. They want to start scaling, vertically and buying some other types of franchises. I mean, it's across the board, people that I work with, and people with, $250,000 net worths to people with $250 million net worths I'll work with. And in terms of getting in touch with me, just reach out to me through my website. It's franchisewithbob.com, or you can email me at bob@franchisewithbob.com.
Awesome. We'll put those in the comments below for everyone, or in the description below for everyone to see. Bob, you really educated me and enlightened me. I truly appreciate it. Thank you for being here.
Yeah, thank you for having me.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.